Good day to everyone. Introduction to corporate tax law in UAE. I am Sijin Kerevi. I have already discussed in the introduction session about the brief intro about me. And this course, it is basically we will discuss about the entire corporate tax law 47 of 2022, and after that one the how to file the return filing. So before going ahead, we should understand what is the business structure in UAE. So we will be briefly discuss about the entire business structure in the UAE to get an idea about how the corporate tax is affected to the each industry wise, even for the individuals also, if it is they are conducting a business. So one by one session while going through, then you will get an idea why this is introduced and what type of entities it is affected. So let's move on to the next areas. So the corporate tax law is initially introduced, the act itself introduced on October 3rd, 2022. Why this date is very important? Because whatever the date, after this date, if you are doing a restructuring of the entire business, then it will be come into the corporate tax law, even if it is effective from 1st of June 2023. So the October 3rd, 2023 is the prime date for the corporate tax introduction. So it is a law, it is called 47 of 2022 Federal UAE Federal Decree Law. So to achieve the economic vision over the next 50 years by supporting a diversified economy, that means the government revenue based on a diversified economy by adopting a tax revenue structure. So the corporate tax has been introduced. So this is the second level of taxation. The first level of taxation, it is related to VAT, that is introduced in 2017 onwards. Then excise tax introduced, VAT introduced. Then of the next level, it's a direct tax. It is relating to corporate tax introduced in October 3rd, 2022. So there are based on the BEPS action, OECD, we will discuss more on BEPS action, OECD point. On the based of the OECD concept, then global minimum taxation. They categorized as two category of the companies. One is MNC related companies and other companies it's a normal company. If it is an MNC companies, then global revenue is exceeding 750 million, then they need to put 15% of tax. And other countries, other companies, it is like a 9% of tax. So this is, we'll discuss in details relating to those things. But before going ahead, what's a business structure in UAE? So let's look at what are the types of taxes in UAE. For example, corporate tax with effect from June 1st, 2023. This is the effective from the law, but issued on October 2022. And the tax rate is 9% above 375,000 and 15% in case of MNC company. And VAT next taxation, it is introduced in January 1st, 2018 onwards, and 5% on all goods and services. Excise tax, October 1st, 2017 onwards, it is applicable for 100% on tobacco products and energy drinks, and 50% on carbonated drinks and sweetened and beverages, and 100% on electronic smoking devices and tools. And next one is relating to customs duty, that is based on the GCC Customs Union Agreement on January 2003. They are introduced for all imported goods 5% on customs duty. And tourist taxes and municipality fees, it is depending upon the Emirates wise, like Dubai or Abu Dhabi or Sharjah or Ras Al Khaimah. Emirates wise at different rates. And between 2014 to 2015, that range, like Dubai, it is March 2014, Abu Dhabi June 2016, Sharjah 2015 and 2016. These are the effective dates for the tourist tax or municipality. So general rate different, Emirates wise it's a different level. So we are not going into deep into this area, but get a general idea about hotel tax up to 10%, tourism fee varies by Emirates, and municipality fee often 5 to 10%. Some Emirates it's a 7%. So depending upon the Emirates wise, it will change. Now let us look at the type of companies in UAE. So first, mainland companies. So formed under UAE Commercial company law. So each emirate, like for example, Dubai having a Dubai economic development, and Abu Dhabi having Abu Dhabi economic development, Sharjah having a Sharjah economic development. So each emirates having its own law, and each emirates will be different authority will be managed. So in general, it's economic development department of the respective, and there is an ownership up to, as of now, their law has been changed. Previously, it's a 49% in the mainland company, 49 and 51%. Now its law has been changed up to 100% foreign ownership allowed with some restrictions. Even some of the industries you cannot do that one. It is like oil and gas industry, then some of the law firm and all these things. There is a restriction, but lot of changes has been. So 99% it's like up to 100% foreign ownership. So what will be the tax impact? All mainland company subject to 9% corporate tax on profit exceeding 375,000, and 5% on VAT if taxable supply exceeds the threshold. Threshold again 375,000, it's a mandatory. And 187,500, it is a voluntary registration. Must register for CT and VAT if applicable. Eligible for double taxation treaties, that depending upon if you are doing with the international companies. Second one, free zone companies. There are a lot different free zones are there. There are 40 plus free zones are there, like a JABSA, Safe Zone, DMCC, ADGM, DAFC, RAC ICC. So a free zone, what is the ownership? 100% foreign ownership, and there are different activity it is there. Based on the activity, you will get the registration. So you cannot do some of the activities, you cannot do some of the free zone. So separate one, like a media city free zone, JABSA, and commodities free zone, then ADGM, DAFC. So activity wise itself, some of the free zones are there. Then what is the tax impact? Again, it is based on the free zone. There is a two type of free zone: qualifying free zone and non-qualifying free zone. If it is a qualifying free zone for 0% CT eligible on income, and non-qualifying income, so it's a qualifying free zone person for respective income only, and we are not talking about the free zone itself. So we'll go in detail with the free zone category, then you'll get an idea. Then non-qualifying income service of mainland, that means a tax rate of 5%. VAT subject to 5% VAT, must register if exceeding threshold. Audited financial and substance is mandatory. And VAT, there are a lot of conditions. If you are doing within the free zone for the goods, then there is no VAT. If it is a service, it is VATable. So those things we are not going into detail. Third company is public joint stock companies like PJSC. So that means it has raised in one of the marketing like ADGM or DAFC, one of the global exchange, stock marketing exchange, then to raise the public through stock market listing. And what is the tax impact? It's a corporate tax subject to 9% of UAE corporate tax, profit over 375. VAT, it is again above, okay, turnover exceed 375. Even corporate tax, then again it's a qualifying income and non-qualifying income, because a DAFC and ADGM is one of the free zones. So again, depending upon qualifying income category, the tax will be changed. That we will discuss in detail in the free zone section. The next type of companies, you can see civil companies or sole establishment. Civil companies like professionals, doctors, engineers or consultants, they want to set up a company, they can do it like a civil company. That means 2 or 3 people are jointly entered to a contract, that is called as civil companies. Or sole establishment. Sole establishment means a single person company is a setup. So at the end of the company's name, it will not come in LLC or FZE or nothing will be there. So that type of companies it will be. Mainly it's civil companies are in a mainland itself, and the sole establishment, there is a free zone sole establishment and mainland free sole establishment. Tax impact, what is the tax impact? Subject to corporate tax if conducting a business. So for example, sole establishment, why it is if conducting a business, it is like for example, sole establishment conducting a business, then tax will be applicable. Turnover is exceeding 1 million. So that we will discuss in details in different lectures. Subject to VAT if they are both threshold, and income is treated as a business income, not a personal income. So if whatever the transaction you are executed in these entities, then automatically it is treated as a business income, then subject to tax. Then branch of foreign company. So you have an entity in another country, for example, let's say in India, and you have ownership here. You have set up a company here. Then it is a branch of the foreign company. So it is automatically the shareholding structure will be the 100% parent-owned purpose and replicate activities of a parent company. So what will be the tax impact? A 9% tax on a UAE source income. You have an option again. If it is a branch, if the other country it is already taxed in higher tax rate, then you can give an exemption also. That option, it is based on the election based election branch option. So that depending, we are discussing in detail in another session. And VAT related, subject to 5% VAT if you are doing a taxable supplies within UAE. Profit repatriated to headquarters may not attract a withholding. That means a profit distribution, it's a withholding tax. And next one is relating to UAE Foundation. Foundation is a legal entity established under specific regulation like ADGM or DIFC or RAC ICC. Only 3 free zones having a foundation setup. So Abu Dhabi Global Market, Dubai International Financial Center, and Ras Al Khaimah International Corporate Center. So unlike other entities, whatever we are discussed, there is no shareholding structure. Instead of that one, it is managed by council members. So beneficiary will be, so for example, a family-owned foundation. So beneficiary will be the foundation members like a parent, a grandparent, children. So these will be the foundation members will be the beneficiary. Then whoever may be joined into that family will be added to a list into that one. So it is just like the entire property, entire asset is managed by the foundation. And wherever they have an investment in any other country or within the country itself, in any other industry, then the shareholders will be, UAE Foundation will be a shareholder. So the entire, it is structure, it is like that different companies owned by the foundation, then the foundation will be the ultimate beneficial owners. So that basis it is taken, so it is called UAE Foundation. So what will be the tax impact? Subject to CT if the foundation carry on business activity. If they are conducting a business activity, automatically it will be taxable. May be exempt if it is a passive investment. Passive investment means a foundation owns another entity in the mainland and you are getting a dividend out of this one. It is already taxed in that entity itself. Then it is called a passive income. You are just passing the income only. So main activity of the foundation, it is just for holding the investment of the members, not for doing any other business. So it is just like a foundation setup. So passive income, dividend or capital gain exempt under participation exemption rule. There are some conditions relating to foundation that we will discuss in detail in another lecture. And not required to register if for a VAT if there is not taxable supply, and if you are required to register above 375,000 if they are doing an economic activity. Economic activity means if they are conducting any business activity. Distributed where whatever the income distributed to beneficiaries are outside the VAT scope, and VAT may apply to commercial transaction. Then if you are doing a commercial transaction with these entities, VAT may applicable. VAT and CT may be applicable. That means you are conducting a business activities. Then next category, it's offshore companies. An offshore company in UAE typically registered like a JAPSA offshore or RAC ICC or Ajman free zones. So what is the tax impact? Generally, offshore company, if you are just set up to holding the investment, holding the assets of the other entity, then it is just like a passive income. Then there is not subject to tax. That not subject to tax, it doesn't mean that they need not to register. They have to register, then they have to file a return saying that these are the exempt categories of income received. If they are conducting a business, then it is automatically it's taxable. And a general rule relating to an offshore company, it is there. They are not allowed to do business inside UAE, subject to some conditions, some activities are there. but they can own any properties in UAE. So the only assumption it is like, and they can own the properties, any properties in UAE, but they cannot do any business inside UAE. So the main activities of offshore will be the international. If you are doing a business activity, it will be international, or you can own any properties in UAE. And so because of those things, they are not subject to VAT, because you are not conducting any business in UAE. So best cases for the UAE offshore: holding intellectual property or investment, owning international real estate, holding shares in foreign subsidiary, asset protection or inheritance planning, international consulting or trading without UAE operation. So all these categories are recently introduced by the foundation part. It is already a better tax option it has given. So before introduction of foundation, offshore was the main tax saving areas, but once the foundation has been introduced, the offshore is a less tax saving concept. The next setup, it is like a special purpose vehicle. So special purpose vehicle you can set up either in ADGM or DIFC. Again, it is one of the free zone. So while seeing that which location it has registered, so because of some of the conditions, it is like a special purpose vehicle. It is a legally specific narrow purpose, typically for holding of asset or manage risk or facilitate funding to the other entities. For that purpose, special purpose vehicle entities are opened. So there are a condition saying that it should be either in a ADGM or DIFC. So once ADGM or DIFC, then you have to just see the free zone tax impact and you have to analyze. So CT 9% taxable income above 375. This is again subject to qualifying income or qualifying excluded activity or whatever the transaction. So it's as of now we have mentioned 9% taxable if it is an excluded, if they are doing an activity, business activity, or if they are doing an excluded activity, automatically 9%. Otherwise it is so all these cases like a free zone category, qualifying income, that area also you have to look into, then only you will get an idea. So you have to see that which location it has registered. Then you have to see whether they are eligible for free zone benefit. If no, then straight away 9% taxable. VAT 5% above 375,000. Unincorporated partnership. So unincorporated, what is exactly unincorporated partnership? So unincorporated partnership is a business arrangement between two or more person entities who are agreed to carry on a business together without forming a separate legal entity. That means you will not having any separate legal entity type, like you will not having any separate legal license, like a LLC license or DMCC license or any private company license. And the entity, it is set up like unincorporated partnership. That means the agreement has been executed in one of the court of one of the Emirates, and based on the agreement you are conducting a partnership business. So that is called unincorporated partnership. So you can set up in either in a mainland in unincorporated partnership. It is recognized under Federal Law number 32 of 2021, that is a commercial company law, civil code provisions on partnership and agencies. So what will be the tax impact on this one? So CT tax impact, if the partnership itself is not taxed, that means it is an unincorporated partnership, so you will not have it in a trade license. So what is the condition relating to the CT? It is like if you have a trade license anywhere in UAE, like either as an offshore or as a mainland company, you must register. But in case of unincorporated partnership, you don't have any trade license. So the unincorporated partnership itself is not taxed, but partners are taxed. So instead of unincorporated partnership, partner is one of the, so three people are entered an unincorporated partnership, each partners are taxed individually. So however, partners can elect for, but there is an option election, partners can elect for, they want to do unincorporated partnership as a taxable person, then in that case individual will not be taxable. So either individual or the entity as an unincorporated partnership will be taxable. So CT impact, resident partners, share of profit of income above 375,000, 9% taxable, non-resident person only taxed if the partnership create a permanent establishment in UAE. VAT if the business revenue exceed 375,000. All these conditions, because once it is an individual or under company name. So if it is an individual, then if individual conducting a business more than 1 million revenue threshold, then automatically 9% will be applicable. So all these conditions, you have to look into the partnership area, or you have to look into the individual status area. So depending upon how you are selecting the criteria, whether at in unincorporated partnership level or the partners level, accordingly tax will be taxable. Next option is a joint venture. So joint venture, it is a business relationship between two or more parties, either as a local or foreign, who collaborate for a specific project. So if you are, for example, a road construction, so they jointly involved in for that project. So there is again joint venture, there is a contractual unincorporated joint ventures will be there, or incorporated joint venture is there. So for example, unincorporated joint venture, so company B and company C as involved in an unincorporated joint venture and made an agreement in the court to jointly do the construction of a road or construction of a bridge or something. So basically it is purely on a short-term basis, unincorporated joint venture. Then that entity, that joint venture will be treated as a taxable person. Unincorporated JV city impact tax transparent by default, like a partnership. So we have mentioned each party pays a CT on share of income. So if it is a 3 companies are unincorporated, that means that they don't have a separate legal trade license, but they have a separate legal MOA or memorandum of understanding to do the business. So based on that one, each entity wise, so company A, company B, company C, each entity wise on their own share of income will be taxed. So if you are not subject to CT, separate entity, unless an election is made. So if you have put an election, then as an unincorporated joint venture as a taxable person, then automatically that will be taxed. Then each partners will be exempt. So same like what we have discussed in unincorporated partnership. Second category is incorporated joint venture, like treated as a taxable person. That means it is you have a trade license and everything. So tax impact will be liable for 9% CT, above 375,000. Free zone company may qualify 0% CT on a qualifying income, subject to rules. So let's see the entire. We have already discussed with all type of companies. So what will be the tax impact range? Mainland companies 0% up to 375, above it is 9%. Free zone company 9% unless qualifying free zone person option, who gets a 0% qualifying income. That means if you are qualifying activities, then you qualifying income, then you will get a 0%. Branch of foreign company, yes, same like CT applicable for local entity. Again, they can give an option for election option that we will discuss later in the lecture. Civil companies and sole establishment, if they conduct a business in UAE. Partnership, unincorporated partnership, partners are taxed individually unless elected taxable entity. What we have discussed, unincorporated partnership, you have an option either partners level or entity level. Offshore company, same as city as a local entity if they are conducting a business activity. If it is a passive, then it is exempt of those income, but a return must be filed. Foundation, taxable if active business or UAE income, possibly exempt if only asset holding. Foundation, if it is exempt only asset holding. Then SPV, taxable if earning in UAE income or active operation, possibly exempt if passive holding only. So it's all depending upon how they are conducting the business activity. Entity is subject to VAT. So we have discussed the city. Then mainland companies are mandatory if turnover exceed 375,000, they have to mandatory register. Free zone company, unless a designated free zone, then partial or exempt, like that there is a conditions. Then e-commerce sellers in UAE if revenue exceed threshold. So e-commerce sellers, that means you have another country, but they are doing a business here, so main source income is here, then e-commerce sellers in UAE, then automatically that revenue exceeds, then VAT will be applicable. Professional service firm like a civil company or whatever we are discussed, then it is applicable. Foundation, VAT not subject to VAT, depending upon, again, if they are conducting a business activity, then it will be taxable. So here it is mentioned that like that not applicable, because it's in the assumption saying that it is not conducting any business activity. So the main purpose of the foundation, it is not conducting a business activity. That's SPV, also similar level what we are discussed in the foundation. Now look at the individual, what is it. So if it is a freelancer or self-employed person, if revenue exceeds 1 million per year of a business activity, automatically CT will be applicable. They have to register. UAE resident with a foreign income, but only UAE sourced business income, then CT applicable. Salaried employees, there is no CT on employment income. Passive investors, like you are getting a dividend or capital gain, then not taxed if not from a business activity. If you are conducting from a sole establishment, then automatically it will be taxable. So it's all depending upon the type of activity, how you are conducting. And individuals are subject to VAT. Freelancers and consultant, if their threshold as HC 375, they have to earnings, that means their income. It is not like a net profit. Here it is a sales turnover. So one is relating to direct tax and the second is related to indirect tax. Earnings is above threshold, then automatically they have to register. Salaried employees, there is no VAT on salaries. Landlord of commercial property, VAT is automatically applicable on the rent. Landlord of residential property, no VAT. Residential leases are exempt. So this is a brief idea about the entire tax structure. Why this concept we are just discussed, because this concept after this session, a lot of areas, like we will be discussing the foundation, we will be discussing the individual taxation, we will be discussing about the SPV, we will be discussing about the unincorporated partnership foundation, unincorporated foundation. All these things will be discussed. Then in that area, you should understand a brief idea about how this business structure in UAE. So thank you for attending this lecture. So next session onwards, you can go to 47 of 2022 law one by one, each session wise, then you will get an idea. Thank you.